Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the definition of inventory. As I do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on to look at some different examples and give you a little bit more insight into it. Inventory is the raw materials, work in process, goods, and or completely finished goods which are considered to be the portion of a business assets which are ready or will be ready for sale. Inventory represents one of the most important assets most businesses possess because the turnover of inventory can be one of the primary sources of revenue generation for a business. Inventory turnover ratio, also known as the inventory turn or inventory turn ratio, is simply a calculation that equals the cost of goods sold divided by the average inventory. I'll show you how to do that in a moment, but I just want to put that in that little definition for you. The inventory line item will be found on any balance sheet, but at least the current assets under the assets section here. And you'll notice that when you have a situation that you're looking at, for example, we're looking at Bank of America, you're looking at a financial service company here, and you will find zero inventory. That is normal because you're looking at a service company, a company that has a service or something of that nature. You're not going to have a lot of inventory. You may even have a little bit for, maybe you're looking at something that they're got some product that they're selling, but it's going to be something like information that they simply download to a disk and then they mail to their customers. There's not a lot of cost there in the inventory section. But if you're looking at like a retail company, let's look at Walmart for example, you will find inventory is a major part of their business. Looking now at the balance sheet right here for Walmart, you can see that the actual inventory on the balance sheet below the assets current asset list, you will find it's $40 billion. That's a substantial chunk of money there, and that's an important element to their overall business strategy. These guys are basically taking cash, using the working assets here, and buying inventory, which is then sold and they turn into receivables or cash, and then cash gets reinvested back into inventory. So this is just this working assets doing what they do. And it's a very important figure here, so we need to know everything that we can know about the inventory in order to really analyze this company. There are three main elements to inventory that every investor needs to fully comprehend. First and foremost, anytime a company has inventory, they are paying to store that inventory. They have to keep the temperature certain, they basically have to keep the warehouse at a certain temperature for some cases, and in other cases that won't matter, but they'll have to keep lights on, or they'll have to keep people working within the warehouse. These are costs that are associated with the inventory, and the longer that inventory sits on the shelves, the more that cost is going to be reflected in the price of whatever you're selling there. So that's one important element. Two other items that you have to know about, of course, would be spoilage. If you're talking about food and things of that nature, if something sits on the shelf too long, it obviously goes bad. You can't sell it, and the actual value recorded here on the balance sheet would then have to be reduced. The inventory is priced based at their costs here, and actually what they expect to be able to sell it at. So if it spoils, they can't sell it and they have to reduce that price there. So that's an important element to note. Another one would be obsolete. If something becomes obsolete, for example, if you were to have computers that were sitting on the inventory shelf there for the past 10 years, what do you think those computers are worth today? Are they going to be valued at the same price they were 10 years ago? No way. Just because they've become obsolete. You're dealing with new technology now, so that's something else that people have to keep in mind. And whenever you're looking at the balance sheet of it, especially looking at the inventory. Whenever you're looking at inventory, of course, those two items, spoilage and items which are becoming obsolete, as well as the cost of just housing the inventory, is not as important if it doesn't sit on the shelves very long. So the inventory turn ratio is going to be a very important ratio that every investor is going to be looking to determine how long is that product actually sitting on the shelf there. So we're going to learn how to do that in a little bit. One more little trick I want to show you right quick. Whenever you're looking at a balance sheet and you want to know whether or not your management is very smart or not, here's what you do. Whenever you're looking at the inventory, especially with a retail company like this, go ahead and scroll on down. We'll get to this later, but I just want to show you right quick. If we scroll on down here to accounts payable, which is basically money that the business has to pay out, and in this case we're talking about the accounts payable here under the liabilities, the current liabilities. You can see that they have $57.8 billion that they have to pay out to their vendors. So basically Walmart says, all right, Carl, we would like to purchase some of your product. go ahead and ship it out to us. So they do, and when they ship it out to them, they send them a bill that says, hey, you've got 30 days to pay this, or maybe it's net 60, or different vendors or different ways. You have to actually dig into the annual report to find out how long you actually have before they have to pay their accounts payable, and every company's going to be different. But typically it's 30 days that they have. So when they have that 30-day time period, then they try to get all that inventory on the shelves as fast as possible and then sell it as fast as possible. And if they're smart, they can sell the inventory before it's actually due in accounts payable. So what basically happens here, smart managers, they'll go out there and they'll try to keep their accounts payable number equal to or larger than their inventory. This way, the company doesn't have to use their own $40.5 billion of cash in inventory. They're in effect using their vendors' $40.5 billion, or in this case, $57.8 billion. It's a short-term loan, basically, with no interest. And so that's the actual tenet that you want to look for if you're looking for smart managers. They're going to keep it that way. They're going to make sure that their inventory on the shelves are being provided actually by their vendors, not by their own cash out of their own pocket. Okay. Now, we're still going to have to know the inventory turn ratio to know whether or not they're going to be able to sell this product before the accounts payable comes due, right? Okay, so that's an important factor. We're going to have to analyze that, and I'll show you how to do that in just a moment. But again, you're going to also have to be looking at the income statement as well as the balance sheet. You're going to need information from both of those in order to calculate the inventory turn ratio. And again, I'm on Yahoo Finance getting this information, but you can find this information anywhere. You can find a balance sheet for a publicly traded company on Google Finance, MSN, your discount broker will provide it. You can also go to the individual company's website, and they'll have the investor relations department there. You can find in most cases, you'll be able to find it provided online for you to look at as well. So that's an important element as well. Okay, the first thing we're going to do to calculate the inventory turnover ratio, also known as the inventory turn, or the inventory turn ratio, is we're going to simply take the inventory and we're going to look at the past two periods here. Now let me get the right data because I'm looking at quarterly here. I want annual. Okay, you can use quarterly if you prefer, but I'm going to be using the annual data on the income statement, so I got to use the same data from the balance sheet, so same time period. Inventory here is what we're looking at, and then we're going to simply take and we're going to average out the inventory for the past two periods. We're going to take this $40.7 billion, add it to this $36.4 billion, and simply divide it by 2. That's one of the numbers we're going to have to calculate there, and it's very simple to do, very easy math, so you can do that right quick, and I'll do it on paper for you. Okay, the math is pretty basic, and this portion of it's going to come from the actual balance sheet. The other, this portion right here, the average inventory, comes from the balance sheet. This section here, the cost of goods sold, we'll get that from the income statement. The average inventory is simply the $40.7 billion from the first period, and then we add that to the $36.4 billion for the second period, and that gets us to $77 billion. We'd simply divide that number by 2, because there's only 2 here, and we're trying to get an average, and we get the $38.5 billion here. And that simply gets plugged into the average inventory right here. This is our inventory turn ratio, and that's where we're going to plug this one in, right? Okay, now let's go to the income statement and show you where you get the cost of goods sold figure. Okay, now I'm looking at the income statement, making sure I'm looking at the same period. You want to compare apples to apples here, so you're looking at the income statement for Walmart, and you can see again that we are again looking for the cost of goods sold, and you'll notice here that what we see right here is cost of revenue, and this is a little detail you need to take note of. Cost of goods sold is basically the cost of whatever they're turning around and selling. When you're looking at a service industry, they'll refer to it as being cost of revenue. When you're looking at a situation like a retail industry, they'll refer to it as cost of goods sold. It's basically the same thing. The only thing here is when you're looking at Yahoo Finance or a lot of the other places, you'll just see cost of revenue many times. It's just a really easy way for them to cover both sides of the aisle. Basically, it means exactly the same thing. And what you're going to do is take that data right there, and you can see that the cost of revenue, or what we're looking for, cost of goods sold, is actually $335 billion. Okay, remember all these numbers are in thousands, so you would add 3 zeros to the number. But anyway, that's the number we're looking for. So we're going to take this number and we're going to divide it by our previous calculation, the $38.5 billion. So let's quickly point that out. Okay, as you can see now, we have the cost of goods sold here at $335.1 billion. This figure right here will be plugged in right here to our inventory turn ratio calculation, and we'll simply divide it by the average inventory, which we already know is this figure right here. Okay, taking that number, the actual cost of goods sold at $335 billion, and we dividing that, of course, by the average inventory, for the period, it's 38.5 billion. We get 8.68756 times. Is that good or bad? Basically, you have to know what it is. First, 8.68 is the number of times in a year that inventory actually gets turned over. And if you want to know whether that's good or bad, you have to compare it to its competition. You want to see what the inventory, you want to see what the inventory turn ratio is for the industry. And so then you can actually compare that to that benchmark and know whether it's actually good or bad. In this particular case, I already know it's good, but that's what you would want to do. You have to take that number and compare it to an industry. One last item that we can do with this information is we can figure out how long the inventory actually sits on the shelf, on the average at least. To do that, we're going to simply take the number of days in a year, 365, and then turn around and divide those 365 days in a year by this number right here. It's 8.68756 number. Okay, so let's do that right quick. Okay, the math is quite simple. 365 days in a year simply divided by the number of times of the inventory turnover ratio of 8.68756 equals 42 days basically. So we know that the inventory on Walmart shelf, whenever you go in there next time, will sit there for an average of 42 days before it is gone. Now, if the company's accounts payable are due in 30 days, that's something we should be concerned with. At least it's something that we should take note of. And if it's, we look into the annual report and we find out that their typical vendor requires that they have paid net 60 days, well, then we know that they were doing so in plenty of time. They're actually selling their inventory long before their bills are even due. So that's why you actually look into the annual reports to figure out all this information and see exactly for this particular company, is this good or is this a troubling sign, okay? So now you know how to calculate inventory turnover ratio, also known as inventory turn or inventory turn ratio, and you know how it works on the income, and the income statement, at least for the cost of goods sold, and what you need to know about the inventory on the balance sheet, okay? Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.